Good afternoon, everyone. Welcome to our 8th CEO Talk. The topic today is credit rating of banks during the pandemic. For AIT alumni, welcome back to another platform, another AIT event. For those who are joining us for the first time, especially on our CEO Talk, welcome to our CEO Talk. This is the 8th CEO Talk in our series. Let's start with a few house rules. If some of you are joining us for the first time, the participants, microphone and audio are muted, so you will be invited to talk or to send questions later in the Q&A section. Today we will start with the introduction of CEO Talk by Dr. Venkatesh, welcome message by Dr. Navid Anwar, Vice President of Knowledge Transfer at AIT, and Dr. Roger Levermore, the Dean of School of Management. And Dr. Venkatesh will introduce about the Professional Master in Banking and Finance program. And Dr. Venkatesh also introduced the speaker of today, Mr. Muzaffar Ahmed. So now please join me to welcome the moderator of our event today, Dr. Sundar Venkatesh, the Program Director of Professional Master in Banking and Finance at the School of Management, Asian Institute of Technology. Over to you, Dr. Venkatesh.
Thank you very much, Dr. Fung. So it's indeed a great pleasure to host this 8th in our CEO Talk series. And we have been blessed here at AIT by the readiness with which many of our eminent speakers have agreed to share the platform with us and spend their valuable time addressing the audience, in the AIT network. I would like to talk briefly about the Professional Masters. It's educational innovation launched by AIT over 10 years back. This is a one-year master degree program which targets working professionals with substantial executive experience. We have professional masters in several key areas. Some of these include project management, construction management, tall buildings, banking and finance, and we also have two new programs coming up in the School of Management, one about business analytics and digital transformation, and another on business risk and resilience. So we have found that the professional masters have a great appeal among working professionals who want to continue their work while earning a degree from an international institution, while studying in the company of participants from different countries around the region. Now, what we also hope to achieve through the CEO Talks is to showcase AIT's rich network of professionals. And, we hope that those of you who are considering a degree with AIT will find this aspect of the networking very valuable. As a graduate of AIT, you will be a part of a very rich alumni network that includes several eminent people. With that, now I hand the floor back to Dr. Phuong for the next item on the agenda.
Next is the video about Professional Master in Banking and Finance. It's 3 minutes video.
As I had been working in the banking sector for so many years, and now I get opportunity to refresh my knowledge about the international banking practices.
PMBF degree is viewed as an international recognized degree. Participants can have more work opportunities from different faculties with very much comprehensive international curriculum.
Yeah, the program of PMBF is customized for what we need to do in our personal career or in our professional activities.
I get to learn here in a very good learning environment with all the resources, with my international colleagues from different countries and faculty who have a very good knowledge on the banking.
Professional masters help me to mix with people of different cultures, religions, and thinking patterns, which enrich my understanding and broaden my outlook and my experience.
Oh wow, it was like just wow, I'm just one of the special ones to be the AITian, and it really feels amazing.
I'm learning so many new things that I know I will grow as a person as a whole.
We had to go through a competitive examination and a selection process.
The instructor and professor are very good and expert at that. I don't have any financial or accounting background or basis, but I feel that I can learn it very easily.
I got the opportunity to meet the top most experienced professionals from various countries as my instructors.
I'm very confident that what I learned here, I can use them in Nepalese banking industry.
Before I joined the PMBF program, my working experience is only in the central banking, not in the commercial banking. But after completing the PMBF program, I have more confidence, more knowledge about the commercial banking to be as a professional in career.
In this year, 2020, I have been nominated for the Japan IMF Scholarship for Asia Pacific, which is well known as DISPA Scholarship, and currently I am pursuing Masters in Public Economic Policy in Hitotsubashi University of Japan. The experience I gathered in PMBF program has enabled me to crack this opportunity.
May I invite Dr. Navid Anwar, the Vice President of Knowledge Transfer at the Asian Institute of Technology, to deliver opening message.
Thank you so much, Dr. Fong. It's been very my great pleasure and honor to welcome our esteemed speaker. As you can see from the designation of knowledge transfer, AIT places a lot of emphasis on how it creates as well as transfers knowledge, and I also learned from the industry and society to strengthen its academic program. So this is a two-way communication that we value very much, in which AIT would like to share its own academic programs and academic excellence with the industry through conducting the programs like Dr. Venkatesh has mentioned, professional programs, other academic programs, as well as many other activities, and at the same time learn from the industry and from the professionals like Mr. Muzaffar and other CEOs joining this talk, from the rich experience that they have gained, and to bring it back to our network, also our students and our faculty, so that our programs can be more relevant. It can produce graduates that are ready for contributing towards the industry and to the economy. So I think this whole idea of knowledge transfer, knowledge exchange is very central to the academia and industry collaboration. So we are very glad that this series, CEO's Talk series, has really gained a lot of momentum, and we have had the pleasure of benefiting from the wisdom and experience of many eminent CEOs like today. So I'd like to welcome once again our esteemed speaker, and I hope that this interaction will actually lead to some collaboration in the future, and we look forward to continuing this with other participants also joining in today. So thank you so much, Mr. Muzaffar, and thank you, Dr. Venkatesh, for giving this opportunity.
Thank you very much, Dr. Navid. May I invite Dr. Roger Levermore, the Dean of the School of Management at the Asian Institute of Technology, to deliver an opening message.
Yes, good afternoon, everybody. I'd like to echo what Dr. Navid has just said about the importance of engaging with practitioners and guest speakers. It's a very important part of the School of Management that we get out of the textbook. And I think one of the strengths of the Professional Masters in Banking Finance, which is the strongest professional masters that we've got, is that we have a lot of interaction with business people. I've been at AIT now for 18 months. My background was in one of the financial hubs of Asia. I was in Hong Kong. And in the last 18 months, I brought in 20 adjunct faculty that fit into a range of our programs, which include in finance as well. And what they bring is management director experience, but also dynamism into the classroom. So they have the mixture of being able to go through and provide relevant information for 2021 and up to 2030, but they also have their finger on the pulse of new developments that are really important within digital transformation, within analytics, within risk, and a range of other subject areas very important to finance. So the thing that I really wanted to go through and outline today is the belief that the School of Management has had very strong foundations. I would like to see those foundations become excellent foundations through things like these type of programs. The School of Management's run over 100 guest speaker programs in the last 18 months, and Dr. Venkatesh and his team are very important within this type of guest speaker program. The last thing I would like to say is that a strong School of Management is based on a very good series of finance programs. So I really welcome you to listen to this presentation today, and I very much hope to see you on some of our professional masters programs in the next 12 to 24 months. Thank you very much.
Dr. Fong.
Thank you very much, Dr. Roger. May I invite Dr. Venkatesh to introduce the speaker of today, please?
We are indeed very thankful that somebody of the stature of Mr. Muzaffar Ahmed is spending valuable time with us today, sharing his extensive knowledge of the financial services industry in Bangladesh. In his early career, Mr. Ahmed was an academic, and that gives a lot of hope for other academics. You can move on from academia to industry and strike a rich vein there in building a fantastic professional career. Now, credit rating, as many of you know, is a very nascent industry in many emerging markets. The idea that someone who is borrowing money should be rated and that rating should be publicly available for lenders to see and act on is something that is new, and many countries have seen a very silent resistance to the growth of credit rating. Borrowers typically have to pay for the rating, and it's not always that they get a good rating. So they pay for a rating and they may not get a rating that they like, and so they ask themselves, why is this necessary? But of course, people like Mr. Ahmed and he's and like-minded people in the regulatory side of the financial services industry have done a great service to countries in making lending much safer, in making credit rating an inherent part of the financial services industry, and in building these institutions which hopefully will serve long and serve well the financial markets of these countries. Mr. Ahmed is has also a stellar record of providing what I call voluntary public service through various institutions such as the Institute of Chartered Secretaries and the Institute of Cost and Works Accountant in India. It also is a matter of great pride and honor that the Deputy CEO of the credit rating agency CRISL in Bangladesh is indeed an alumnus of SOM, Dr. Syed Mamun. He's here. And over the years, Dr. Mamoon and I have worked together on many different things. And it's indeed a matter of pride that Dr. Mamoon himself is doing very well in the financial services industry. And he has indeed been, instrumental in introducing AIT to Mr. Ahmed, who is with us here today. So, in extending a warm welcome to Mr. Muzaffar Ahmed, I would also like to extend our heartfelt welcome back to Dr. Mamoon. The School of Management is actually a second home, if you like, and we hope to see more of you here as the school picks up more and more programs and courses in finance. As the Dean said, that finance will be an integral part of the curriculum here, and Dr. Mamoon's work can, of course, contribute in a big way to the learning of our students. So, Mr. Ahmed, a very warm welcome, and thank you very much for coming. We look forward to a very, very interesting talk. Dr. Fern.
Sir, could you unmute, sir?
Sorry, I think it's okay now. So, I first of all, good afternoon to all of you. Aslam Alikum, and I welcome you in a very interesting discussion session on a subject which I like much, and especially it gives me a remembrance of my early days when I was a teacher at the university level to discuss on finance and accounts and many other issues. So here, just taking the words from Dr. Sundar, that is two things he came, what is defining credit rating. That actually when I started credit rating, one of the managing director of bank defined credit rating as a pay somebody to abuse you. That is he paying me and thus to abuse you in his front. So this is very interesting at that point of time for me. And I have also taken one of your alumni as the deputy CEO with the understanding that he will take the flag of rating in Bangladesh and to assist me initially, and also he take over initially in course of time. So can I share my screen now? It is, yes, I think please. It is closed.
Kanji, yeah, you're now the co-host, Mr. Ahmed, please.
So after the talk by the speaker, we will have a Q&A section for the participants. Yeah. So.
I share permission this.
Yeah.
Yeah, sure. না আমি পুরি নিতে আমার ভিডিও হবে না এটা So before I go to my presentation in a small scale, I want to tell you that we are the two words, that is banking sector and the COVID-19. How these things are very linked into the economy. That I want to focus. So before I take about the COVID, I want to say a few words about the credit rating and its impact on the banking. That will give some idea about how the rating in banking is coming to in the picture. The recently pandemic affects the global economy, as you know, very seriously. Globally, the banks are considered to be the barometer, in judging the economic development of any country economy. Therefore, impact of pandemic in the banking sector will clearly give a picture about the world economy, country-wise economy, and its impact on it. Credit rating is one of the international tool to assess the health of a bank. we will discuss the issue of how rating views the health of a banks in the particular in the economic sector with reference to Bangladesh. So what we actually define by credit rating? The credit rating is an impartial, independent, and best judge professional opinion on the ability and willingness of a borrower to discharge the obligations in timely fashion. So this is a very important definition. If we review the above definition, the following points will come up. That is, it is impartial. It must be impartial. That is why people, a decision of a credit rating can be believed by all because it's impartial. It's not impacted by any of the partiality or having some conflict of interest. And it is very independent because if you rate an organization, you must be independent. Even you are independent of the fees. When initially we start rating, we ask the client to pay my fee before I disclose the rating, because otherwise there may have an opening thinking that if I give a bad rating, that they may not give me they may not go for payment. That is why we used to collect payment even before giving the initial rating. So it must be independent from all angles, and it is best judge opinion. That is from all perspective in a financial, economic, and sector niche and everything. It must be best judge opinion for all. And let me, I want to close this thing. I need to close product. I hope it. And after best, it should be professional opinion, not that we are discussing something based on certain facts and figures. It should be professionally, internationally acceptable opinion. That is why credit rating is impartial, independent, best judge, and professional opinion. That is why the globally it is accepted. And it must be in a very timely fashion. Say somebody, some obligation is to pay it on a particular date. If you pay it after that date, it does not necessarily mean that you are a good paymaster. So you'll have to consider to pay in a very timely fashion, exactly at least the same day. And there is very important thing. It is not only that ability. The ability we, as a later analysis, we do normally on the financials and other economic factors, but willingness is absolutely important because you may have some money with you, but you're not paying it. So willingness is also considered for the, in fact, we factor willingness also in judging a rating assessment. Willingness actually coming from many things, how many questions frequently asked that how you see the willingness. The willingness is, for example, while I have seen an organization rated in India that they are asking for the utility bill of the CEO. I asked them why you are asking for these things. They want to see that CEO has all the right to pay, but how far he has got willing to pay, propensity to pay in him, we want to see by going through the bills of his utility bills of his residence, because his company is paying, but whether he's paying in time or not. What is the due date and when he paid? So this way, the willingness also factored in credit rating. If you look at the international level, there are many rating agencies internationally known. They are doing country ratings and also rating of many banks and financial institutions, sometimes single or even with the two rating agencies at the same time, because this credit rating is considered to be the acceptable to the investor. That is why globally Standard & Poor's, Fitch, Moody's, Japan Rating Agency, Islamic International Rating, and so around 8 or 9 rating agencies internationally, they are working globally. They are doing country rating as well as the big corporates and banks of that particular jurisdiction. So there are about 60 rating agencies operating at international and national and international level, and these eight or 10 around, they are internationally very known, and others are operating in the local jurisdiction. So operational areas of international rating, as I told you, that is already country rating. They are doing rating at international scale, and that is interest in the international scale. There are two types of scales being applied by rating agencies. Say I'm in Bangladesh, I have decided, I have factored the government as the high pay master. That is a AAA. That is the highest I can go. But country Bangladesh is in the international scale of S&P and other international rating agencies. They are BB minus. That is the very marginal of the investment grade. So they are doing from the international perspective, and we are in Bangladesh, we consider even the government as AAA. So rating scales are very important in judging the quality of rating and other things. Here normally rating is expressed in terms of some alphabets internationally. AAA is the highest rating. That is no risk equivalent to government notes, highest certainty of payment. That is the high paymaster. AA, very negligible risk. Then down below A, small risk there, but the obligator has the capacity to discharge it. BBB, risk is there, but still considered to be investment grade. And from BB onward, it becomes a below investment grade, and it goes up to down below to D. D means default or going to default. So each and every rating agency defines this AAA to D with plus minus, considering that it is in the range of, say, for example, AA minus. That means it is just entered in the AA. Or if it is no sign plus minus, that it is in the middle, and if it is AA plus, it indicates that it is at the upper end of the AA rating. At any point of time, it may go for AAA. So these are the this is expressed with these symptoms, and internationally it is accepted and knows. However, all the rating agencies do not follow the same scales. They have got their own distinct signs, but normally alphabets are used for the rating scale. Now, as I want to tell you that credit rating is a global concept to judge creditworthiness of the individual, corporate, government. Where it applies, the field. I can rate an individual client, I can rate a corporate or a government or any institution, it is a sectoral institution or a bank, and so on and so forth. So rating is widely accepted globally in these sectors. And coming to Bangladesh, I want to give some idea within 5 minutes about how I came in picture in Bangladesh and how rating in Pakistan. Actually, it was back in 1994 when there was the Euromoney conference in Bangladesh, and around 104 countries participated in that Euromoney conference. And one of the shortcomings they identified why Bangladesh is not getting the foreign direct investment, although all the governments, maybe opposition, position, whatever, they all tried their best to bring the foreign direct investment in Bangladesh. But it is not up to their expectation. It was because of the fact that although we do not, Bangladesh doesn't have any rating agency by itself, but internationally, this country has been rated as C. C means highly speculative, highly risky. And when there are international community, investment community who are looking for investment outside the developed countries, they identified Bangladesh is not the country where they can invest. That is why the foreign direct investment is not up to the expectation of the government in Bangladesh. Based on this, they have recommended that Bangladesh should try to have at least one rating agency at the private sector to develop the rating concept, methodology, and so on and so forth. So with this situation, the Security Exchange Commission chairman came to, at that point of time, I was serving as Director of Finance of a USAID project, MIDAS, where my boss was a Harvard MBA, and he has a friend in the Security Exchange Commission. The associate chairman asked him to explore the feasibility of setting up a rating agency in the private sector. Then he came to me that you give me some idea about how a rating company functions, works in the country. So being a cost and management accountant, I had some idea, but no detailed information about rating, how it works. So I have visited some of the countries, India, and also some of the countries in US and UK, and identified that, well, we need to have a rating agency, at least one in this country, but market is very, very negligible because no market is there that some rating agency should function. So what I have started, I floated along with some of the business people, I floated a small rating agency as a public limited company, closely held public limited company with 7 or 8 people, and approached the Security Exchange Commission to license us. But licensing was very, very difficult for me because at that point of time, the Security Exchange Commission, the people are changing, the chairman was changing, and they actually do not have so much of the seriousness on these things. Plus, and they are also not serious why I am trying to do alone without taking the World Bank or the Asian Development Bank. They considered that in order to make trustworthy rating agency, I must have to share some shares with the World Bank, IFC, or Asian Development Bank. But these organizations are very commercial. They came up with the approach of Security Exchange Commission. They came up that, well, you should have a rating agency, okay, but you don't have the market. Why don't you ask the Indian rating agencies to rate some of your products or other things as and when needed? That was not liked by the Security and Exchange Commission. Then they came up, they want to have a rating agency, they want to recognize me, but I want to have at least some multinational rating agencies to be with me. Then I was in contact with the Duff and Phelps at that point of time, when it was later on it was converted to Fish rating agencies. Then they said that your government was not serious. They almost took quite a good number of years to decide, so they are not interested. So having all these, at that point of time, World Bank came up. They want to give some donation to develop the bond market in Bangladesh. And one of the requirement was that Bangladesh should have at least one rating agency. Then they came up to assist me to have the license, and they gave me license. And first I started with the bank rating. But unfortunately, at that point of time, I was not very serious about, sure about the rating methodology that to be applied for bank rating. I tried to approach S&P and other. They demanded so much of the money that it was not possible to pay for the methodology. So what I have decided on a sudden, it came to my mind that while I was going to Thailand, I have seen a rating methodology book in Malaysian Airlines in the airport. That was written by some S&P retired people, the bank rating methodology. So I have all along gone to Kuala Lumpur to purchase that book and back to Bangladesh again in the same next flight to develop my own methodology of developing bank ratings. So that was the start. And after that, there was no regulation at that point of time. So only regulation was that you will have to have in Bangladesh, if any bank goes for right offer at a premium, that needs to be rated. So first rating, I started with Al Baraka Bank, one of the defunct bank in Bangladesh at that point of time. It was under the control of Bangladesh Bank. They have given the people to control their affairs. So we have rated this as this bank is basically, it is almost the default, technically default, because this bank will not be able to pay any money after within next 12 months. Then central bank asked me why you are saying they will not be able to pay. We are looking after the banks. And but I gave the explanation of how technically I have seen that the technical default of the bank. Fortunately or unfortunately, after few months, after 12 months, the bank really failed. And one of the newsmen, he could identify a page from my my rating report submitted to Bangladesh Bank, that CRISL identified it 6 months or 10 months before, but it was not in that. It was not taken by the Bangladesh Bank at that point of time very seriously. So at that time, our Sanshad, that is our parliament, was on, and they asked the Bangladesh Bank and the governor to make the rating mandatory. In 2004, they came that banks will have to rate it by rating agencies mandatorily when a year is completed, and within 6 months they require to submit the rating report. That is how in Bangladesh the rating came in picture. First of all, as bank rating, then later on insurance rating, insurance company rating, the general insurance companies, non-life insurance companies every year, and life insurance companies every 2 years. So these things came in picture. But it was not so known to the people unless and until the Basel II, the bankers capital adequacy Basel II came in picture by the International Bank for International Settlement (BIS), and then it came in picture in a very greater scale. So I'm going a bit because these are the things I discussed. Now, credit rating is sometimes confused with the equity research or equity rating or equity grading. Basically, this should be very clear to the students, particularly. I should say, credit rating is looked from the perspective of the creditors, whether bank will be able to discharge its liabilities to the creditors in time. And equity rating is totally different because for equity rating, the earning prospect of company is considered, and also whether the company is paying dividend or not. If dividend is paid regularly, then it is considered to be a positive point. But if it is not, that is not a positive point. That is, but in credit rating, if you pay dividend, that it considered a negative point because the creditors, the internal capital generation of bank is highly affected with their dividend. So in credit rating, it is considered the bank should not pay at least they should not consider the equity dividend payment as a factor to be considered. So these are the things, and I will also discussing how counterparty ratings came in picture. So before coming to the concept counterparty, let us discuss something about the banker's capital adequacy, which is considered as the one of the very important tool to see whether a bank is performing good or as per expectation or as per regulation. Capital adequacy means a bank must have adequate capital to run the business. It is unlike the corporate. Say, for example, bankers, when they finance a project, they want to see at least 60-70%, at least 40 to 50% amount is paid by the sponsor, and the balance bank is going to finance. But unlike this corporate, the capital bank's business is with the money. And if you look at the balance sheet of a particular bank, you will say 8 to 9% is the capital, and balance 92% is the liability. And these liabilities are given 100% guarantee by the bank that under any circumstances, they are going to pay the money. That is to bring the confidence of the depositors and also the investors in bank. So only 8% there is no guarantee that it will pay. It is equity, and 92% is guaranteed. Now, taking this 100 amount, they are spending in a very vulnerable economy where the investment at various cadres are in a vulnerable position depending on many factors like economic situation, sector, and so on and so forth. So taking this money, putting in an economy and bringing it back is really difficult. That is why the central bank doesn't allow any bank to go random by taking the deposit and give the money, make the money investment in the economy. No, that is not desirable. So you will have to have a adequate capital and proportionate your liability to go for investment. That is the whole concept of capital adequacy. In Bangladesh and also in globally, 10% of the risk-weighted assets, That is, you make the your assets risk weighted and make 10% at least the minimum capital bank should have. The how they calculate the risk weight, say for example cash bank balance, it is multiplied by 0. That means 0 risk, for example. And making money to the say invested in say in a multinational company may be less risky, so multiplied by say 20%. So in this way, and when you go to the private sector, when it is 100% risk weight multiplied by 100. So whatever amount you are getting as a your total equity, total assets as a risk weighted, minimum 10% is to be considered as a capital. So this is called the minimum capital. If it is more than 10%, 15%, 20%, that is fine. That is most welcome. So central bank globally fixed a minimum capital requirement, and banks are asked to maintain the minimum capital requirement to remain compliant. It is one of the compliance requirement from the central bank. Now, before Basel II, Basel I it was that, and when Basel II came in picture, Basel II backs just to give a small background, Basel is a town in Switzerland, where the headquarters of the Bank for International Settlement (BIS), it was headquartered in the Switzerland in a small city called Basel. That is why they give the name Basel to memorize it or to commemorate it. So Basel II is the capital adequacy formula given by the BIS with the understanding that banks will have to maintain the minimum capital adequacy. So with the development of the commerce and education globally, and they identified not only the credit risk, a bank has got other risk also, which is even more important than credit risk. That is operational risk and market risk. So when you calculate the capital adequacy, unlike previous Basel I, you will have to consider credit risk, operational risk, and market risk along together to have this 10% capital adequacy requirement. So the Basel II, this is the most formula. Now, how you will calculate credit risk, operational market risk? There are BIS suggestions are there, whether you go by the standard approach or advanced approach, so on. So I'm not going to all these details. That will make the things more complex. So we in Basel II, we require to calculate the credit risk, operational market risk, and in Bangladesh, in India, and other countries of the subcontinent, they from 2009 onward, that is initially in Bangladesh at least 1 year for on trial run, then it made it mandatory with effect from 2010. The problem is now that when you are financing a client, that is when you are risk weighting your assets, how would you see? Is the bank to decide whether it's risky or non-risky? That is the question came in, and it was given formula given by BIS is that unless and until bank goes for a standardized approach, that means advanced approach, that means they have their own credit rating company within themselves to decide on the risk, they can use the service of the credit rating agencies globally having at least 3 years of minimum experience, and their default ratio is not than 0.003% at triple A. That was the formula given by BIS to start with. And as a result, the central bank came up to give the license to the recognition to the rating agencies. Some of the rating agencies having all these phenomena like at least 3 years, experience, and their default ratio. Default ratio means how many of your clients are defaulting at a particular point of time. The how globally, internationally, credit rating agencies are judged whether it is a good rating agency or a bad rating agency in terms of the default ratio or a matrix of your transition. For example, some of the clients are rated AAA. It should not default within at least 10 years in the circumstances. Say I have rated AAA 100 clients, and these 100 clients should not default within at least 10 years or 12 years, whatever it is. Now, after that, what is the ratio? So when you look at the experience, then you will get some, it is since it is considered to be less risky. On the contrary, that if company or a client rated as BBB and defaulted, that after 5 years, that is okay. That is okay because it was a BBB at the lower band of the investment. Or if it is a BB, it is already in the process of risky, so it may default within the next year. So rating companies are considered to see whether it is good company or bad company in terms of its default ratio. So in this way, the credit rating companies are judged, and they got the license from the central bank as external credit rate assessing institution, external credit assessment institution, ECAI. So in Bangladesh, the Bangladesh Bank at that point of time, there are 2 rating agencies. All the 2 rating agencies are given license to work as ECAI. So CRISL and other rating agencies were in picture. Now, the question of counterparty ratings are coming. That is very interesting, because banks are in Bangladesh, as I told you, they are maintaining the minimum capital adequacy requirement of 10% of risk-weighted assets. Why? Because capital is less. By originally paid amount was that was 400 crore or something like that, the minimum capital, and our the client, sorry, the whatever given in the small economy. So that was the banks have started with a very small amount of capital, and Bangladesh has got a huge number of the banks operating in this country. So that is why our capital was minimum. So initially, to make compliant, what banks started, they started to raise capital by giving the either bonus share or by giving a right offer and so on and so forth. But at a particular point of time, when they see that they are going for additional capital is increasing the risk on giving dividend on the investment on the equity. That is why they started to take the formula given by the Bangladesh Bank that say, for example, you go for the client rating. Although it is not mandatory, that is straight away Bangladesh Bank is not saying that you get the clients rated, but bank is forced to go for client rating because, for example, I'm giving you one example. Say if you are financing a client having AA rating, you need only taka 2 as a capital to finance 100 taka. That means capital requirement is less because it is a less risky client. That is why in case of AA, say only 2 taka, that is 20% risk weighted is required to make 100% 100 taka investment. If rated B, then your capital will be more, that is taka 5 for financing 100 taka because of the risk inhibited there. And if it goes even, it may go even 12 and 5%, 125% risk weight if it goes below the investment rate. So what the banks started doing, they